The Epstein class hides behind money and structures. Their biggest tool? Modern transnational capital. Governments tried to bring capital back inside the nation state after World War II, but capital found the exits. In part one, we covered how capital learned to move. Here in part two, we'll cover how capital learned to disappear. The first life of transnational capital was built through banks, charters, empire, and public debt. The second life is built through offshore law, private banking, trusts, and shell companies. Capital learned to cross borders and use opaque layers to stay hidden. Remember, capital gains power through mobility. After World War II, it gained power by separating control from ownership. This gave elites privacy, reach, and a choice of jurisdictions, while governments tightened financial surveillance on average citizens. To understand how we got here, we have to start with Bretton Woods. The postwar order began with fear. The Great Depression had shown what happened when money fled. The war had shown that states could command credit when survival demanded it. So after 1945, the architects of the system built Bretton Woods. Currencies were fixed. The dollar was tied to gold. Trade could expand, but finance was supposed to move carefully. Governments wanted room to rebuild industry and protect employment. Then the exits opened. The first major escape route was the offshore dollar market. In the 1950s and 1960s, dollars began piling up outside the United States. Banks in London could take dollar deposits and make dollar loans beyond the direct reach of American regulators. These were called Eurodollars, American dollars held offshore. By the 1970s, Bretton Woods broke. The United States ended gold convertibility. Fiat exchange rates began to float. Capital controls weakened across much of the developed world. This is when transnational capital entered its current form. Factories, debt, and profits could all move, and they did. Ownership moved with little public visibility. As American manufacturing hubs moved overseas, elite wealth soared while the working class faced wage pressure, hollowed-out towns, and fewer domestic opportunities. The multinational corporation became the central institution of the age because it could turn itself into legal architecture. One affiliate could own intellectual property, another could borrow money, another could sell to customers, another could employ workers. A product could be designed in one country, assembled in another, and taxed through a third. The firm became a coordinator of flows. Its real power lay in where it placed each piece of itself. The same logic then moved from corporations to families. The ultra-rich can hide wealth by separating control from ownership. The person who benefits from an asset may sit behind a different legal owner. The trust is central to this system. A trust separates legal title from economic benefit. Assets are held by trustees. Beneficiaries receive wealth without holding title. The founder can still influence the structure while another party appears as the legal owner. Layering makes the structure harder to see. A shell company can hold a mansion. A trust can own the shell company. A foundation can sit above the trust. A professional intermediary can administer the paperwork. Several layers obscure the full ownership chain. This separation makes private wealth difficult to attach to a person. A tax authority may see a company. A creditor may see a trust. A journalist may see a nominee. The person with influence may sit behind all of it, completely unseen by anyone. The Panama Papers made that distance visible. In 2016, a leak from Mossack Fonseca exposed more than 11.5 million records. It revealed offshore entities used by politicians, criminals, celebrities, and wealthy families around the world. The deeper lesson was that Mossack Fonseca was part of a global service industry. Its product was separation. It helped separate assets from names and wealth from visibility. Then came the Pandora Papers. In 2021, leaked records from 14 offshore service providers showed a larger system. The investigation exposed hidden structures linked to world leaders, public officials, billionaires, and fugitives. It also showed that secrecy had moved into the United States. South Dakota Dynasty Trust became the symbol of hidden wealth inside America. The Pandora Papers identified U.S.-based trusts linked to foreign wealth and politically exposed people. American trust law had become a secrecy product, even when individual trusts served lawful ends. The machine works because each jurisdiction sells a different advantage. One sells low tax, one sells secrecy, one sells asset protection, one sells legal permanence. That is why wealth can compound across generations. Lower tax drag leaves more capital invested. Privacy reduces pressure and risk. Trust laws shield assets from litigation. Advisors update the structure as rules change. The structure preserves wealth through legal design. That legal design creates a darker possibility. If wealth can be hidden, people can be hidden too. If ownership can be layered, responsibility can be layered. If records can be scattered across jurisdictions, accountability can be made slow enough to fail. And this is where Jeffrey Epstein and his clients enter the story. The Epstein network showed how elite wealth, private banking, political access, sexual exploitation, and secrecy operated inside the same architecture. Epstein's world had islands, aircraft, trusts, and famous acquaintances. Guilt requires specific evidence beyond proximity. But the network around him was built from the same materials as transnational capital: mobility, opacity, privilege, and distance from ordinary law. Epstein used the U.S. Virgin Islands as a financial base. Public filings and investigations described entities around him, including Southern Trust, Financial Trust, the 1953 Trust, and aviation companies. His life was organized through legal vehicles as much as personal accounts and his vile sexual appetites. The structure gave him room to operate. He owned islands. He moved money through banks. He built relationships with officials. According to J.P. Morgan court filings, the U.S. Virgin Islands gave him more than $300 million in tax benefits and waived monitoring requirements tied to his sex offender status. A jurisdiction can become part of the machine. A wealthy man brings money, influence, and business activity. Officials offer incentives and protection. Banks keep accounts open. Lawyers keep the paperwork clean. The result is a system of mutual convenience. Everyone benefits from silence. The recent Epstein files only confirm this. Millions of pages have been released, many still redacted. The public has seen more documents, more names, more interviews, and more institutional failure. The wider elite network around him has produced few corresponding arrests. Yet the public has seen years of access, private settlements, sealed records, and unanswered questions. Epstein is only the visible part of a larger structure. The darker implication is that his role was a function. He brokered access. He gathered secrets. He moved among billionaires, politicians, scientists, and royals. He sat where money, status, and compromise met. And the scariest thing is that all of his functions were simply replaced by new people. If blackmail works as a form of power, it survives any one financier. It migrates. The people change, the islands change, the intermediaries change. The incentive remains. This part is hard to prove, but easy to understand. Elite networks run on shared exposure, shared interests, and shared silence. A network built on secrecy becomes self-protecting because everyone has something to lose. Everyone is compromised in some way. The Leon Black relationship exposed the financial side. Black paid Epstein $158 million between 2012 and 2017 for tax and estate planning services. A Senate Finance Committee investigation said Epstein advised on transactions designed to avoid more than $1 billion in future gift and estate taxes. The Epstein case fits transnational capital for that reason. It shows how private wealth can build a private jurisdiction around itself, a private zone of banks, lawyers, properties, and sealed agreements. States have fought back, but unevenly. Automatic information exchange expanded. FATCA gave the United States more reach. Beneficial ownership rules improved the paper trail. Investigators gained better tools. But wealth also pushed back. Sometimes the pushback comes through courts. In 2022, the European Union's top court struck down public access to beneficial ownership registers, citing privacy and data protection rights that weakened public visibility. Sometimes the pushback comes through politics. In 2025, FinCEN removed beneficial ownership reporting requirements for U.S. companies and U.S. persons under the Corporate Transparency Act. Foreign companies still faced rules. Domestic entities were exempted. Sometimes the pushback comes through structure. If one country tightens bank secrecy, money moves into trusts. If one registry exposes companies, property moves through other vehicles. If one structure becomes risky, advisors design another. Transnational capital finds loopholes and creates markets for them. The rich and well-connected have no shortage of international loopholes to keep scrutiny at a distance. Average people remain trapped inside their own countries. They are taxed on spending, income, gains, gifts, and death. Inflation pumps the asset values of the rich while eating the purchasing power of working class wages. Bitcoin is another part of this story. For average people, it offers the only true form of financial exit. Bitcoin appeared in 2009 in the middle of a financial crisis. It allowed value to move from one party to another without a financial institution. Bitcoin functions as a peer-to-peer digital network that settles value without trusted intermediaries. Anyone can easily create a Bitcoin wallet and start receiving, saving, and spending Bitcoin. No permission needed. No way to freeze it. Unstoppable digital money. That makes Bitcoin part of the same transnational capital story, though it works differently from offshore trusts. Offshore structures depend on lawyers, banks, and secrecy jurisdictions. Bitcoin depends on code, private keys, and network consensus. Protocol rules issue Bitcoin, a distributed network runs it, and transfers move without trustee approval. A person can hold Bitcoin directly through a private key. Custody is power. In the old system, wealth depends on institutions that can freeze, disclose, or block it. Bitcoin offers another model. The owner can hold the asset directly through a private key. Bitcoin is also trustless in a precise sense. Users rely on network rules for ledger updates. The network verifies transactions through rules. The ledger is public, and every node can check the history. Offshore finance hides ownership through opacity. Bitcoin moves value through transparency. Every transaction is visible, though the identity behind an address may stay unclear. For people under inflation, repression, or capital controls, Bitcoin serves as protection. For criminals and tax evaders, it can move and store value. The feature is the same. Value can cross borders without gatekeepers. Bitcoin gives individuals a form of financial exit through direct custody rather than shell companies or trust offices. It is stateless in a way traditional assets never were. Across Bretton Woods, offshore finance, and Bitcoin, the thread is control separated from location and clear ownership. Offshore dollars separated money from domestic regulation. Multinationals separated production from profit. Trusts separated benefit from ownership. Bitcoin separated custody from institutions. The advantage is the ability to choose among jurisdictions. Ordinary people live under one tax system, one currency, and one set of rules. Transnational wealth can compare systems. It can choose the friendliest law. It can move when visibility becomes dangerous. Capitalism became global. The money of the wealth in secret throughout the moves in secret throughout the world. Once capital escapes the local state, the question changes. Who can touch it? Who can tax it? Who can expose it? Who can stop it? At the highest levels of transnational capital, the answer is no one.